talked in these videos before about the long-term success of value investing, particularly deep value investing. Yet recently in the press there's been a number of articles talking about the lack of performance that value investing has achieved in the last number of years, particularly I would say since the financial crisis, which causes me to contemplate, if not value investing, if not deep value investing, then what? So there are other investment strategies out there. One, of course, is growth stock investing, where investors look for a company with accelerating growth and look to buy that company because they believe their shares will grow to match that accelerating growth. An issue with that is that it's very difficult to forecast growth, and often the implied growth rate is already built into the share price, and if the growth rate proves to be disappointing, those stocks can fall and stay down permanently for a permanent loss of capital. Bottom line is that growth stock investing historically has not outperformed value investing. The second idea might be momentum investing, whereby an investor invests in those companies, or a portfolio of those companies whose share price has most recently risen. And there is some scientific evidence to support the idea that this is a successful strategy. However, the issue is that the portfolio changes so quickly, with one group of momentum stocks losing momentum and transferring into another group of momentum stocks that is just gaining momentum. The costs are so high as to cause the strategy overall to be ineffective on a cost basis when actually practically implemented. What about macro investing, where an investor thinks about the macroeconomic forces that are at work in the world and kind of funnels that down to sectors that might benefit from that, and funnels that down further to companies that might benefit from that? At issue here is that you're making decisions on many different levels, and human beings by their nature are just not good at laying one dynamic decision on top of another and coming up with a good logical outcome. So what about perhaps private equity investing? We've been reading a lot about private equity investing and how many of the pension funds have been moving their capital from public market investments to private company investments. And there's nothing wrong with this. Private companies can be very attractive investments. One of the things to keep in mind here is that with a private company, there's no mark-to-market pricing. Therefore, there's no volatility, which feels attractive, but there's also no liquidity. So an investor in a private company has the benefit of not enduring the ups and downs of the marketplace. However, they have no liquidity until there's a transaction that takes place for control. And those control transactions will be the same whether it's a public or a private market investment. So my caveat with respect to private market investing is simply that it's been very, very popular. With this increased popularity comes increased valuation. With increased valuation comes increased investment risk. So that's kind of the landscape of possible alternatives to value investing. But unfortunately, I think it brings us right back to the reason why we are value investors. It's been said by Benjamin Graham that investing is most successful when it's most businesslike, and there's no type of investing that's more businesslike than value investing. So we come full circle, and we remain patient, and we try and take the value principles and apply them in a way that is successful in a modern society, in a modern economy, a modern stock market.